When you're forced to start drawing money out of your pre-tax retirement accounts, that's right, at a certain age, you're required to do so. How do you calculate that required amount? Okay, and then is it the same amount every single year? What's going on with that? What are the rules? What are the most common questions? Well, I've got those questions and answers coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so hopefully as you're saving up for your retirement and your financial future, you are using the right tax shelters. This is one of the most important components of your financial plan and the value that your CFP should provide, and that is making sure you're using the right tax shelters as you save up. Why tax shelters? Because they've got some tax benefits as you're saving for the future. Those tax benefits could be a deduction of your contributions on the way in, so the dollars that you contribute deducted from your tax return and you don't pay tax on those contributions. All of the activity in the account is sheltered from taxes as well, so the interest and dividends and capital gains, none of that shows up on your tax return within these tax shelters. And then when you withdraw the money, that either comes out tax-free if it's Roth, or taxable if it was pre-tax to begin with, or HSA or whatever. So anyway, those are in general tax shelters. That's one of the biggest components of your financial plan, making sure that you're using the right one each and every year, and then leveraging them when it comes to your retirement. For pre-tax retirement accounts, so IRAs, 401k, pre-tax 401ks, by a certain point, by a certain age, the IRS says, all right, enough is enough. You've got to start taking some money out of this thing. We're not just going to give you tax benefits forever. Start drawing some money out. You are required to draw a minimum amount out or take a minimum distribution. So that's the required minimum distribution, RMD. Used to be that this needed to happen at age 70 and a half. Why 70 and a half? No one stinking knows. No, you don't celebrate half birthdays. Some laws changed it. The Secure Act changed it to age 72, and there's a proposal out there right now trying to push it to age 75. I hope they push it out to 85. I want you to have as much flexibility and push this requirement out as long as possible, although I do get it. The IRS has said you got to start paying some tax on this. So the year in which you turn 72, you've got to start drawing out a minimum of this amount. You can't draw out less. You've got to draw out at least that amount to the dollar or more if you so choose. The year you turn 72, you actually have the option to say, yeah, you know what, I don't want to take it this year. I'll take it next year instead. But then you've got to take two of them, okay? You've got to take one before in the first 3.5 months of the year. You've got to take another one again the rest of the year. So how is it calculated? Get this question a lot. How is it calculated, and is it the same amount every single year? Or I took this amount last time, I'm assuming I have to take the same amount this time. So here's how the calculation works. I'm even going to show you a worksheet. You don't need it. Your CFP should do this for you. But here's a worksheet from the IRS on how you calculate it. So you take the balance, the amount in your pre-tax retirement account, so your IRA or pre-tax 401k. You figure out what the balance was on December 31st of the previous year. Okay, so 12/31 of the previous year, and then you divide it by a divisor, okay? You divide it by a factor that is found on the Uniform Life Tables that the IRS, that the government publishes. They update these every once in a while. This, I don't believe, has been updated for several years. But basically, you divide it by your life expectancy. And how do you come up with your life expectancy? You've got to use this specific table that the IRS says you have to use. So you take your balance on 12/31, not on 12/30, not on 12/27, not on the high point of last year or on the low point of last year, whatever the balance was in your IRA, your pre-tax retirement account on 12/31 of the previous year, and you divide it by that life expectancy number based on the age that you're going to be in this year, okay? So that's what you do, and that's how you calculate what you're required to withdraw each and every year from your pre-tax account. That's how you calculate your RMD. Your certified financial planner should do this for you. Sometimes you'll receive a letter in the mail. Sometimes, you'll have it on your statement, okay? You shouldn't have to calculate this yourself. If you do, I'd have someone double check it. But the point is of explaining this formula is that number will change every year. It will change every year because you are a year older, so it's going to be divided by a different number, is number one. And number two, your balance is likely changing. You're not going to have the same balance in your account on 12/31 each and every year because you're taking withdrawals, right? And you haven't invested, so that's going up, going down, going sideways, whatever. So likely that's going to change as well. Should it be similar? Yeah, it should be similar. But is it going to be the exact same? No. So you can't set it up and say, well, my first required minimum distribution is $12,000. I'll take $12,000 a year exactly for the rest of my life. No, but I mean, you've got to calculate this RMD every single year. Again, you could draw more than this out, but you've got to draw this exact amount, or you've got to draw at least this exact amount, okay? If you're already drawing a monthly amount to supplement your Social Security, supplement your pension, whatever, and when you add all of that up, that exceeds your required minimum distribution, then you're good. You're all set. You just then need to make sure that you draw all those monthly withdrawals out, or quarterly withdrawals, whatever you do. But if you're not drawing dollars out, that's where understanding exactly what this calculation is and then working with your CFP to say, should I draw out this exact amount or should I draw out a little bit more? How much do I withhold for taxes? So that's how RMD works. Now let's hit some of the most common questions related to RMD. What if I forget to do it? What if I forget to do it? Well, you shouldn't. You should be working with the CFP, and they're going to be watching and monitoring, and they should have alarms and alerts that come up to make sure that you handled this. But what if you forget? This is one of the steepest penalties in the books. It's a 50% tax penalty, meaning if you were supposed to take $12,000, the tax penalty is $6,000. And then to make matters worse, the $12,000 is still taxable on your tax return. You still have to draw it out. You give half of it to the government, and then you calculate your tax and give them their tax as well. So very, very, very steep penalty. You're going to want to make sure that you're paying attention to this and working with your advisor on it. If you have multiple IRAs, do you need to take a withdrawal, a minimum withdrawal from each of them? No. For IRAs, you can aggregate all of your IRAs into a total required minimum distribution, and you can take that total out of just one, or you can take it out of two, or whatever. You don't have to take a specific amount out of each IRA. They are aggregated. However, if you have a bunch of IRAs or an IRA and a 403B, you can't aggregate those. You can aggregate all your IRAs, but each 403B is separate. Each 401k is separate. You can't aggregate all your IRAs and 401ks and just draw it out of one. Your IRAs can all be lumped together, but your 401k is separate. Your 403b is separate. What if you have a simple IRA? What if you have a SEP IRA? No, those are IRAs. They fit within that IRA family, so you can aggregate those as well. Okay, Mike, you mentioned that the reason the IRS tells me I have to do this is because they want me to claim it on my tax return. So how do I know how much to withhold for taxes? That's a financial planning question. That is a financial planning question. We help people with that all the time. Guys, some people, we tell them you should withhold the entire thing for taxes. Not because the whole thing is taxable, but because they're not withholding taxes on their Social Security, or they have a lot of capital gains and they're not withholding taxes on those. So you've got to be doing proactive tax planning to look at your entire tax picture and see how this required distribution fits within that required tax picture. Maybe it means you shouldn't withhold any taxes on it. You get this, it's all fun money, whatever. Or you've got to look to see what tax bracket you're in and, okay, withhold 12% and 5% or 22% and 5%. But the reason why I would say this, that you've got to do financial planning and look at how this withdrawal fits is a lot of times, if you haven't been drawing this money out, you've been drawing Social Security. And so depending on your other income, that may or may not mean you're paying tax on your Social Security. Well, come 72 or 73 and you're forced to start drawing this money out, well, that could change your taxability of your Social Security, okay? If that is confusing, I've done other videos about that. Check it out on this channel. So therefore, by drawing this RMD, this required minimum distribution out, it may create more of your Social Security to be taxable. Therefore, you should withhold more tax on this. Work with your CFP on that. What if I don't want the money? What if I don't want to take the money out? Well, if you don't want to take the money out, you have very few options for avoiding it. Number one, while you're still working for your employer, if you're required to take a distribution, you're exempt from taking it from that 401k. So you'd have to be 72 or older still working for your employer. Your 401k, you don't have to take a required distribution from, but your IRAs you would, okay? So that's, again, not very fun. There's not great options here, but if you're still working, know that you at age 72 or after, you don't need to take a required distribution from your employer retirement plan. Another option is you could look at a qualified longevity annuity contract. You give up some rights with that, but you do have some options there. Another is all of this discussion about required minimum distribution has to do with pre-tax retirement account. You could have dollars in a Roth, right? Roths, an inherited Roth has a required distribution. You've got to pull the dollars out within 10 years. But your own Roth IRA, there's no required distribution, at least not yet. And so being planful all along to have more dollars in Roth and less in IRA, that's a way to avoid this as well. If you've explored every opportunity with your advisor to lessen or reduce or eliminate your required distribution, and you still say, well, I've got to take some, but I don't need it, I don't want the money, you can reinvest it. You just have to withhold the right amount of tax and then transfer it out of your IRA into an individual investment account or joint investment account or trust account. You cannot take your RMD, your required distribution, and convert it to the Roth. You are not allowed to do that. You can take it out and reinvest it in a non-IRA, non-Roth IRA, just an individual joint account, trust account, something like that. So I hope that helps. I hope that helps, give you a little bit of how the sausage is made with required minimum distributions. What I can't stress enough, though, is planning for it all along, okay? When you're in your 30s, your 40s, being age 72 seems like an eternity. You think you're never gonna get there. But if you're saving up proactively for your retirement, most of your retirement, you'll be age 72 or older. So it's prudent to be thinking about how are you planning for RMD all along the way, okay? So work with your certified financial planner on that. And if you're close to that age or you are that age, work with your certified financial planner to say, well, what's the minimum amount I have to take out? And then what tax bracket does that put me in so I can withhold the right amount or I can take advantage of other tax planning strategies? If you don't have a CFP that can help you with that, you can always contact one on my team. Find us online, Korhorn.com, that's Korhorn with a K. WiseMoneyShow.com, you can find us there too, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.